Last week, Amazon suffered a major cloud outage that lasted nearly 24 hours, taking down much of the internet, including popular apps like Robinhood and McDonald's, and even disrupting airlines. As an investor, when I saw the news, I expected Amazon stock to drop, and I was eager to add some to my portfolio at an attractive price. But the drop never came. In fact, the stock opened even higher on Monday than where it was the week before, and it continued to trade upward to be up 5% this last week. In this week's market update, we'll talk about what happened with Amazon, why the stock went up on the news, and what I think about this company going into their earnings this week on October 30th. We also had some news from Apple, which hit all-time highs in their stock price this week based on headlines claiming that the iPhone 17 Pro is outselling previous models, as well as Netflix that was down close to 12% after having to pay an unexpected tax bill. I also want to share with you one stock that I think could be an attractive value opportunity for those value investors watching this video. By the way, if you're new here, my name is Brian. I'm a former investment banker with a Master of Science in Finance, and my goal is to help you master the market. So let's start with Amazon, and this clip from CNBC does a pretty good job going a little bit into detail in terms of how widespread the impact is.
There's a good chance today that some website, app, or service that you tried to use today was down. That's following an outage from Amazon Web Services. Mackenzie Sigalos joins us now with more on what exactly happened. Hi, Mac.
Hey, Morgan. So more than 11 million users have now reported problems, and the count is still rising as this AWS outage drags on. Now, the trouble stems from Amazon's Northern Virginia region. That's its oldest and busiest cloud hub, still the default for countless apps and platforms. This is the same data center complex that Amazon has leaned on for years, where many major platforms first set up shop. This hub has seen multiple disruptions over the past 5 years. Now, AWS says it is making progress fixing the internal network failures that triggered all this, and we are starting to see service disruptions come.
Now, here I want to highlight just the extent of the different types of companies and websites that were affected by this outage. It's not just a few different websites, it's also video games and services that folks will use on a day-to-day basis. You'll see here Asana, which is a popular workplace tool. You've got FanDuel for gambling, sports gambling, EA Games and League of Legends, which are some pretty popular video game companies. You've also got Rainbow Six Siege, and then you've even got Lyft, where folks are unable to use the Lyft app and get rides from point A to point B.
Back down. Cyber experts also stressing this is not a hack, but it is another reminder of the risks that come with centralized cloud infrastructure. Despite growing pressure from Microsoft Azure and Google Cloud, AWS still controls more than a third of the global market. Investor sentiment.
Now, I want to stop and highlight this chart because one interesting thing about this situation is some folks online are joking that this was actually one big marketing event for Amazon. I don't think they did this on purpose for marketing, but when you look at this chart, it really goes to show that Amazon is such a dominant player in the cloud computing space. You can see that they've got 29% of cloud market share. This is as of Q1 in 2025. The next company that comes close is Microsoft's Azure at 22%, and then you've got Google at 12%, and these are the three players that make up over 50% of market share in the space. Now, for someone like me who hasn't been following the stock every single quarter, this definitely got me to lean forward in my seat a little bit, as I knew that Amazon was growing with respect to AWS, but I didn't realize exactly how dominant they were in the space. The other piece that I want to point out here is something that was just glossed over quickly by CNBC, in that this was not a cybersecurity attack. In fact, this whole ordeal is likely attributable to human error, and that's not going away anytime soon, at least not until AI and robots replace all of us. And it's certainly going to be true for other providers as well, like Microsoft's Azure or Google Cloud. I think the real downside would have been if this outage were caused by some sort of fundamental flaw in the infrastructure that Amazon had built out.
I wonder, there's an agentic AI challenge here, it seems to me, right? Because we're talking about AI all the time. That is sitting on top of the cloud. If this were 5-10 years in the future, if you don't have people to answer the phones because the agents are doing it for you, or analyze your sales or crunch your numbers, does a cloud outage become a work stoppage for companies? I mean, it seems like the stakes are only getting higher for the economy as we rely more and more on these resources.
I mean, today laid bare the fact that Perplexity doesn't have a robust enough multi-cloud strategy. I'm out to Anthropic to hear whether they've suffered disruption, but we haven't seen reports of that. And that's because they rely on a mix of cloud providers, not just Amazon, But Google Cloud, we also saw OpenAI diversify away from just working with Microsoft Azure, their Google Cloud customer as well, to prevent exactly this, John. You can't have reliance on one single provider anymore.
Let's break this down. So the concern here is that as companies move more of their output towards being powered by AI, whether that's by displacing humans or by adding AI to the mix, let's say you have companies now 20% of their productivity is powered by AI, but then 5 to 10 years down the line, AWS goes down again, and suddenly 20% of the workforce, which is technically AI, is offline. It's almost like 20% of humans just went to sleep and they're not going to wake up for another 20 hours. And then the question that comes out of this is, to what extent are Amazon's customers going to diversify their spend with Amazon's cloud services? So for example, if you have a company that's currently spending $100 million per year on AWS, maybe after seeing this, they'll decide to spend 50 million of that with Microsoft Azure and keep 50 million of that with Amazon. So in that case, Amazon would lose $50 million. While that argument is valid, in my opinion, this shows that Amazon has about as much to gain as they do to lose. As we saw, they are a dominant player in the space, but they only have 29% total market share. That leaves another 71% of market share that could diversify into Amazon. So on the other hand, if you have a company that's currently spending $100 million per year, say on Google Cloud or Microsoft Azure, they may see this and have a wake-up call that they shouldn't be on just one provider, and maybe they should split that up with other companies, including with Amazon. So maybe they'll take their $100 million Google Cloud budget and move $50 or $30 million of it to Microsoft Azure, and another 20 or 30 million or so over to AWS. And when it comes to these big news events, I think we as investors should really focus on the fundamentals of the company. So here I've got a website called qualtrim.com. It's made and maintained by another finance YouTuber here named Joseph Carlson, who I absolutely think you should check out. So if we take a look at this company in terms of where they've been and where they're going, the first thing I want to note is the consistency and the upward trajectory of this company's financial metrics. If I draw your attention to revenue, we can see that 10 years ago, they were earning $100 billion per year, and they're now at $637 billion as of 2024. In fact, from 2020, just 4 years prior to that, through 2024, this company added $300 billion of revenue, which is roughly about how much they need to get to that $1 trillion mark. Just think about that for a second. This company is on a path to make $1 trillion per year in revenue within the next 4 years. However, today, their market cap is just at 2.39 trillion. And as we go through a few more of these financial metrics, we can see that AWS has been a pretty big driver of this revenue growth. Back in 2018, AWS was just making $25 billion, but as of 2024, it's gone up 4x to over $100 billion. Amazon's also growing at a pretty healthy rate in the high teens. Here you can see 19% and 17% as of Q1 of 2025. And when it comes to profitability, this company has consistently been able to increase its earnings, net income, and free cash flow, of course, with exception to 2022, which was a pretty bad year across the board. And when it comes to valuation, this company is by no means a value stock. I mean, it trades in the mid 30s, and ideally, if you're a value investor, you'd like to see something between 12 and say 20, maybe 25 if you're really willing to stretch. But when you compare this to the overall valuation of the S&P 500, which is sitting at 40 times price to earnings, we're talking .com 2000 era level of valuation, then a company that has this much growth, this much profitability, and this much consistency trading at a valuation in the 35 range might be a little bit more attractive than the broader market. So when it comes to investing in Amazon, I'd really like to see the stock price come down before I add any to my portfolio. I've been following this company on and off for over a decade now, and it's one of those companies that goes up in fits and starts. It's not like a straight up line, and if you don't invest today, you're going to miss out on lots of gains. If we look at just over the last 10 years, you'll see exactly what I mean. We had this run up in 2017 into 2018, say late 2018, and then all the way from late 2018 to early 2020 when the pandemic hit, the stock didn't really do much. It just traded mostly flat. Then we had a big run up from the pandemic. And again, from mid 2020 over to mid 2022, a whole lot of nothing from this company. Then in 2022, when we had fears of recession and 10% inflation, the company traded down, and somewhere in this area below 150, I think would have been a reasonable buy, whether you're buying up here or you're perfectly timing the bottom. And then we have another run up from late 2022, early 2023, all the way to, I'll call it middle of 2024. And from middle of 2024 until now, the company has gone up a bit, but it's been very volatile. It's gone down, then up, then down, then up again. So I am not getting up out of my seat to go and add this to my portfolio right now. I'd like to see how the company performs on their earnings this October 30th. And if we see a little bit of a correction, whether it's from, say, an earnings miss, or if we see some kind of broader softness in the economy and stocks start to sell off, then somewhere between the 150 to 200 range is where I would think about adding this to my portfolio. Next, let's quickly talk about Apple. This is another company that I've been a big fan of for a long time. And full disclosure, I'm an ecosystem guy. I've got an iPhone, an iPad, a Mac. I've got just about everything Apple has to offer. But I want to show you this article that said Apple closes at record after strong iPhone 17 sales report for US and China. Apple shares rallied after the iPhone 17 series outsold the iPhone 16 series in China and the US within the first 10 days of availability. And I thought, oh, that's really interesting. I didn't know that Apple had, published any of these numbers. But then if you finish the bullet point, it says, according to Counterpoint Research. I personally had never heard of Counterpoint Research, so I decided to look them up, and here's what I found. When I Google Counterpoint Research, I find the exact website that is being cited here. And it looks like this chart here is the one that is driving all of this price action in Apple stock. Let's take a look at it. China and US market iPhone 16 and 17 sell out, first 10 days availability. So we've got these two bars here, and we see a 14% increase year over year. But I started to get a little bit confused because when you look at the numbers within each chart, I see 19% for the base model going to 22%. So that's an increase of 3%. Then I see 76% for the Pro Max, and then 75% for the iPhone 17. And that's down 1%. So now we're up 2%. And then we go from 4% up here for these other models, for the Plus compared to the Air, from 4% to 3%. So overall, a change of positive 1%. I think that this here is the mix of the total, but what we're missing is the total number of units from one point of time to the other. Now, I'll link this article so you can go see it for yourself if you'd like, but I took a read through and it's unclear exactly how Counterpoint Research is getting the data that the sales have increased for this model 14% year over year. And the reason that I'm skeptical of this is because normally I upgrade my phone every year. But what I'm holding in my hand here is the iPhone 16 Pro Max. And to be honest with you, the upgrades this year just weren't enough to get me to go upgrade to a new phone. The other thing I want to mention, and of course, this is just my own observation, this isn't some sort of rigorous research, and I don't have millions of dollars to spend on staff and go run surveys for me. But normally, after a release of a new phone like this, I start to see the new iPhone pop up everywhere. This year is one of those years where I'm not seeing that happening. I'm not seeing all of my friends go and upgrade to the new iPhone. I'm certainly not feeling any pressure to go get the new phone. The 16 Pro Max has everything I need, and I wouldn't be surprised if the numbers don't shake out as rosy as this first 10 days of signal are from this Counterpoint Research report. And I don't want to take a little dig at this research report and at Apple with at least looking at the fundamentals. But when we look at this company, what we see is relatively stagnant growth. I don't think that Apple is a particularly bad company to invest in. I think over the years, they've been a really strong stock. But if we go down to the valuation of the stock, you can see that they are trading at close to a 40 times price to earnings, despite having a little bit of a lower growth rate compared to, say, an Amazon, like we just looked at. As we saw, Amazon was growing year over year around 17 to 19%. But when we look at Apple, we see that year over year, this company is growing at 9%. And the revenues have really started to trail off year over year since they jumped in 2021. And the story here with Apple has really been the lack of innovation. Of course, the iPhone 17 looks a lot different from, say, the iPhone 5 or the iPhone X. But when it comes to innovation, Apple's recent attempts have been lackluster at best. They came out with a headset that isn't really getting a lot of purchases. And they came out with the iPhone Air, which seemed to be a little bit of a leap forward. It's a very thin phone and really seems like something that Steve Jobs would have designed. But there are now articles starting to pop up that Apple is cutting back production on the iPhone Air because of underwhelming demand. So while I like Apple, like I said, I'm addicted to the ecosystem. I've got just about every device that they have to offer. When it comes to investing in the stock, I'm certainly not going to be adding any to my portfolio unless I see the company's stock price come down, say around 15 to 20% from this current level. Okay, so next let's talk about Netflix, which saw a near 12% decline in their stock price last week after missing earnings expectations because of a tax that they had to pay for doing business in Brazil. And when I was doing some research on this, I found a good article from this website called deadline.com. So in total, Netflix had to pay $619 million in tax expense. And this spanned from years 2022 all the way through 2024. And here's what the CFO had to say on the call. Two really important takeaways that I want to leave you with. The first is that no other tax looks or behaves like this in any other major country in which we operate. So it's understandable that this was unexpected. Netflix likely didn't have anyone who was very familiar with this specific tax on their operations team out of Brazil. And so it's no surprise that they were going without paying this tax for those years and had to pay it retroactively. Quote, and secondly, absent this expense, we would have exceeded our Q3 25 operating income and operating margin forecast. And we don't expect this matter to have a material impact on our results going forward. So there are two important notes there that I want to highlight is that one, if it weren't for this tax, Netflix would have actually beat Wall Street's estimates. And the second one, which I find very interesting, is that this tax isn't going to impact Netflix going forward. So this is a one-time expense. It's technically related to doing business, but it was just for a few years from 2022 to 2024. And moving forward, it's not going to have a further impact on their business. But you wouldn't know that from looking at the drop in their stock price. It almost looks as if Netflix lost 10% of their customers overnight. Here's a little bit more detail on the tax as described by Netflix management, which I think you might find interesting. They say, it's a bit complicated. It's a cost of doing business in Brazil. It involves a 10% tax on certain payments made by Brazilian entities to companies outside of Brazil. It's not a tax that's specific to Netflix. It's not even specific to streaming. So we assume other companies will be impacted by this. In our case, Netflix Brazil pays Netflix US for services that enable Netflix Brazil to offer subscriptions to our Brazilian customers. And we actually received a favorable ruling from a lower court back in 2022 that concluded we were not subject to this tax, which is why we believed we couldn't accrue this. But even though they had that favorable ruling in 2022, in August of this year, the Brazilian Supreme Court decided against an unrelated company, so setting precedent, ruling that the tax applies to a wider range of transactions than we thought was legally permissible, including service payments that don't involve the transfer of technology. So given that court's ruling, that caused Netflix to reevaluate the likelihood of prevailing, and they have now put the loss on their books and they recorded it in Q3. So with that in mind, let's take a look at Netflix's fundamentals and I'll tell you a little bit about what I think about the stock. As we go through, you'll see a similar story to what we saw with Amazon. Very steady upward revenue growth. Back in 2015, they were making about $6 billion in revenue. And that's gone all the way up to $39 billion in 2024. Netflix has continued to add subscribers to their platform. So they were at 89 million back in 2016. And they're now at 301 million today. And you can actually see that they've re-accelerated growth from 2022 all the way to 2024. Now, I remember quite a few years ago, the concern with Netflix was that they were spending way too much on content. They were spending billions of dollars on trying to create the best shows in the industry. However, when you take a look at that KPI, you can see Netflix content budget here. It was increasing very rapidly through 2019, and there was a big jump in 2021. But ever since 2021, the company's been a lot more prudent with the amount of money that they spend on content. And even though they're not spending as much on content as they were back then, they're still coming out with massive hits, including K-pop Demon Hunters, which released earlier this year. And I expect Stranger Things, which I'm definitely going to be watching later this year, to be another big hit on the platform. Now, when it comes to profitability, there are a few different measures to look at. There's EBITDA, there's net income, and there's free cash flow. As a stock investor, net income and probably free cash flow are the two that I think you should worry about. As a quick side note, if you're unfamiliar with these three different measures of profitability and you'd like a little bit more of an explanation, I would love to hear from you in the comments and I'd be happy to let you know. But the last piece to consider here is their valuation. Netflix trades at a pretty high multiple. As we saw, the S&P 500 trades around 40 times, and Netflix, even with the drop in their stock price, is trading at 45 times. So it's definitely trading at a premium to the broader stock market. But I think given where we are, there's nothing we can really do about where broader valuations are sitting. If I were a growth investor and I've been sitting on the sidelines waiting for an opportunity to add Netflix stock in my portfolio, this would definitely be an opportunity for me to do so. Even if it's to start with a small position, say I have $10,000 to invest, I might think about doing $5,000 now and just waiting and seeing if the stock comes down a little bit further and say it comes down another 5 or 10% and adding the other $5,000 later. Now, there is one company that I promised to share with you at the beginning of the video, and this is specifically for my value investors watching this. You might be looking for a company that has a good price to earnings ratio, a solid brand, and potential for future growth. And in my opinion, Target is a good candidate to put on that list. Now, when we look at some of the numbers associated with Target, you're certainly not going to see a growth stock. Like I said, this is a value stock, but their stock price is down over 30% year to date, despite relative stability in their revenue and their profitability metrics. And what's really caught my eye about Target is their stock seems to have hit a little bit of a bottom over the last month or so, and from that low, it's up about 8 or 9%, and I think could have a lot of long-term potential. And this last week, we got news that they plan to lay off 1,800 employees, so there definitely are some cost-cutting initiatives going on at the company. Now, with that said, Target certainly has its fair share of issues. Here's a little bit from a memo the CEO shared with the company when they announced these layoffs. Quote, "The truth is the complexity we've created over time has been holding us back. Too many layers and overlapping work have slowed decisions, making it harder to bring ideas to life." And on top of that, the company is also facing boycotts related to changes in its DEI policies. But from my perspective, as an investor, when I look at this company and its fundamentals, I do see an opportunity. And there are really two opportunities that I personally see for this stock. If they remain a public company, it would be to address their current business structure, all of those complexities that were mentioned by the CEO, really modernize their operations to get back to a point of scalable efficiency. And the other is to address these boycotts. It seems like they're really having a material impact on the company's performance. And so Target should try to find some sort of middle ground to appease those that are boycotting the brand. The second scenario is called a take private, in which a private investor comes and buys this company off of the public stock exchange, decides to make their own changes to the company, and re-IPOs that company in the future. And the situation that Target currently is in is the perfect setup for a lot of these private investors. They trade at a really good value, they've got really good assets, and perhaps with some new ownership and management changes, Target can reclaim a lot of the brand value that it had before. Often these take privates can come out of the blue, and the price that can be offered to shareholders can be anywhere from 20 to 50% usually above the current share price. So for anyone investing around $90 per share, Target may get taken private at around $120 to $150 per share. But those are just some possible scenarios that I could see unfolding. I would love to hear from you. What do you think about Target? Are you considering adding it to your portfolio? Do you think it looks like a value stock, or do you think it's just going to stagnate or even continue to go down from here? With that said, I hope you enjoyed this video. Let me know what you think down in the comments below, and I will see you in the next one.